Well, stock futures losing some steam in early trading, a fire hose of market catalysts between big tech earnings and the first FOMC decision of 2025 could make or break the market's recovery from Monday's sell-off. Joining us now is Gargi Chaudhuri, who is the BlackRock Americas Chief Investment and Portfolio Strategist. Gargi, great to have you on the program here with us ahead of the opening bell, ahead of these earnings, ahead of the FOMC decision, the first of 2025 here. What is the setup? What is the market going to place the most priority on?
Good morning. It's great to be here. Happy Lunar New Year to all those who celebrate.
Happy Lunar New Year.
Yes. Yeah, absolutely. So the first thing that I think the market's going to focus today, just in terms of sequencing, of course, is how Chair Powell talks about the restrictiveness of policy rates. Obviously, of all of the meetings in the last couple of months, this is probably the least exciting. We don't get an SEP. We're most likely not going to get any moves on interest rates. But at the same time, I think the market's going to place a lot of emphasis on how Powell characterizes the restrictiveness of rates, how Powell talks about any impact of ongoing tariff discussions on the impact of inflation, and to what extent they still think that there's balance between their risks. So those are the things that market participants will be watching for. Going straight after that, I think all eyes are going to be on the large earnings that are coming out after close. Always important, but probably especially important now, given the volatility that we saw in the markets earlier this week.
Gargi, how much is at stake when it comes to these big tech results?
I think a lot. I think, honestly, what we have seen, and this isn't just about DeepSeek or any of the innovation related to that, but I think if you look at earnings growth expectations, what has been incredible through the course of 2025, expectations of earnings growth is expected to broaden out, but tech and the Mag 7 are still the dominant drivers of earnings growth. So we're going to have to see if some of those earnings materialize. So that's number one. And we just came out with our year ahead outlook earlier in January. We actually told investors to definitely continue to focus on high quality companies, but then also have an eye towards certain parts of value where we're beginning to see earnings growth come in. And we certainly saw that at financials earlier this earnings season. So yes, earnings really important, but the broadening out story is healthy for markets. And we saw that on Monday, where 70% of the index was actually up on the day.
Gargi, you also outlined three big risks and possible hedges at this juncture. What are they?
Thank you for bringing that up. Over the last 3 weeks or so, even before the sell-off on Monday, clients have been asking us around how they should be thinking about hedges as well as diversifiers away from the large cap tech names. So the way in which we're laying out the framework is, number one, continuing to focus on the expansion of other areas of earnings growth, like I pointed out. So whether that means remaining very active and nimble with dynamic factor rotation strategies, or whether that means moving towards areas of large cap value, that's one of the things that investors can do. The second one, and I think this is really important, one of the ways in which investors can especially hedge their portfolios in a rising inflation environment and a rising geopolitical risk environment is perhaps think about inflation-linked bonds, especially in the front end of the curve, as well as an allocation or considering an allocation to gold as well as Bitcoin. And we've seen a lot of flows in both the front end of the market. STIB has garnered a lot of inflows, as well as IBIT, of course, which has been a huge flow gatherer. And then lastly, I'd say one of the last things that we've been saying, focusing on, especially when tariff risks are concerned, focusing on companies, especially tech companies that are that have some energy, some tech independence associated with them. So that's another area of the market that we're telling investors to focus on.
Gargi, going back to what you just said a moment ago, when you're talking about considering allocation to gold and to Bitcoin, I guess how much should investors be allocating in terms of some of that exposure? What does that look like in terms of trying to determine that and obviously balance some of that risk?
Absolutely. So our colleagues in BlackRock Investment Institute have actually done some work on this, and we've seen that, in a 60-40 portfolio, that's what you have. The percent allocation it's obviously how you think about the allocation of risk versus return. So your Sharpe ratio, so the amount of return that you're getting divided by the amount of risk, that you need that to pick up. And if you add about a 1 or 2% allocation in a 60-40 portfolio to Bitcoin, I think that you're getting some reasonably good pickup in your Sharpe ratio in that case, especially when you look at the returns over the last 10 years. If you get meaningfully higher than that, the risk associated with obviously a larger allocation than that 1 or 2% becomes too high. So that's what we're telling investors to think about. Similarly with gold, many investors actually do not have an allocation to gold at all. We think that especially in a geopolitically fragmented world, continuing to think about adding a gold allocation with things like IAU to your portfolio make a lot of sense. And again, that can be a geopolitical hedge as well as perhaps even a little bit of an inflation hedge.
So that's even an acknowledgement that it is safe to, at least long term, weigh in or at least bring on some more risk, even if you're thinking about cryptocurrency and that even small single-digit percentage allocation for your portfolio. Is it Bitcoin alone, or is it other currencies as well that you think could benefit?
The work that we have done has been specifically on IBIT. So I want to be very clear about that, especially given that is where we're beginning to believe that investors know that there'll be more adoption, right? So the work that I was stating around the 1 or 2% is very much around Bitcoin. And obviously, we've seen a lot of flows as investors think that this is going to be something that's going to continue to have broad-based adoption. When it comes to gold, that is something that obviously has been adopted into portfolios for a very long time. But more and more, increasingly, we're finding that investors believe that this is going to be a good hedge, a good diversifier as well in geopolitically fraught times. So I think thinking about what role each plays as a diversifier or as a hedge makes some sense. And then the last thing, and I want to talk about this just for a second, because I think we're in an environment of increased volatility in the markets. We think it makes a lot of sense for investors to continue to focus on the front end and the belly of the fixed income market to generate yield in that portfolio, but also think about, instead of moving to cash, if you're worried about what earnings might bring or what further sell-offs in the markets might bring, think about buffered strategies as a way to sort of preserve your upside and then give you protection on the downside.
Gargi, always great to see you. Thanks so much for taking the time.
Thank you for having me.